I'm the president of CAPSARC, which is an advisory think tank in energy economics and sustainability located in Riyadh, Saudi Arabia, with our international experts from 24 countries who collaborate with peers around the world to share knowledge, insights, and analytical frameworks. CAPSARC's work touches on all aspects of energy. First, I'd like to offer a huge thank you to the organizers of the first IAEE International Online Conference, the International Association for Energy Economics and the Association for Energy Economics France. Merci. Today, we will be discussing the role of oil in the great transition in energy that is underway. Some definitions of energy transition refer to the global energy sector's shift from hydrocarbon-based systems of energy production and consumption, including oil, natural gas, and coal, to renewable energy sources like wind, solar, as well as batteries. A more pragmatic approach, in my view, focuses on emissions, especially carbon dioxide, but methane and standard emissions like sulfur and nitrogen oxides as well. They're the problem, and sees the energy transition as a shift towards cleaner fuels and carbon managed fuels that remain accessible and affordable across the world. Today, we will look at some of the challenges and opportunities for the oil industry as it seeks to adapt to pressures for change in this direction. Our panelists today include Dr. Helen Curry, Dr. Bassam Fatou, and Dr. Francesca Holtz. Helen Curry has over 25 years of experience in the business, government, and academia area. She brings unique perspectives to corporate strategy planning and portfolio risk management in her current role as the chief economist of ConocoPhillips, a global oil and gas company. Bassam Fatou is a specialist in energy commodities, particularly oil and oil products, and with expertise in the Middle East and North Africa. He is the director of the Oxford Institute for Energy Studies, a world-leading independent and autonomous energy research institute. Francesca Holtz focuses on the interaction of fossil fuels with climate policy as the deputy head of the Department for Energy, Transportation, and Environment at DIW Berlin, the German Institute for Economic Research. DIW Berlin is a leading economic research organization. So now we'll hear from Helen, who is going to examine the supply and demand fundamentals for oil and oil's likely share in the energy mix. Over to you, Helen.
Good morning, good afternoon, depending on the time zone you're in. I'm Helen Curry, Chief Economist with ConocoPhillips. And as part of the oil and the energy transition session here at the IAEE conference, I will be speaking today about the global oil markets, as well as a focus on the role of the United States oil production in the future of energy. So let's start with where the oil markets are today. Coming out of the pandemic of 2020, we're still on a path to recovery. Demand today is roughly 96% of where we were pre-COVID. So we think about that in the context of where oil demand was in 2019, as indicated on the slide. And we expect oil demand to recover over the course of 2021 and 2022. A key threshold that we focus on is the 100 million barrel a day mark, because that's essentially the average oil production or oil demand, rather, for global oil demand in 2019. And in our view, the market will get back to that level on a sustained basis in 2022. Needless to say, there are many risks around that. The resurgence of COVID in a number of countries today and continued lockdowns is putting some pressures on the demand side. But then there are offsets to that with strong growth in countries such as the United States and China, where vaccines have been more widely available and the economy is better able to open up. On the supply side, OPEC and Russia and the broader coalition that they are part of has done a strong job of restraining production and helping to rebalance the market. The level of solidarity around that coalition is inevitably an open question. They're showing great cohesion at this point in time. However, history shows us that the longer these agreements to restrain production stay in place, the greater is the likelihood that some member countries start to exceed what their allowance is. But at this point in time, the overall group is abiding by the agreed upon quotas quite well, particularly at the aggregate level. And in the United States, we've seen production back off. Many producers voluntarily reduced production during the pandemic. Prices were very low. It didn't make sense to continue to produce at those prices. So there were large cutbacks, and much of that is coming back today. So turning to what is the longer term outlook for global oil demand in the future? In our view, there is a long life ahead for oil in the energy mix and in the world's oil demand. Let's start over for this slide. So turning to the outlook for global oil demand, there are many projections that show oil demand growing for many years into the future, and that is our base case view at ConocoPhillips. We do plan our business around a range of scenarios with both higher and lower levels of future oil demand. But when we look at how the world relies on oil and petroleum products for energy, there are many sectors which should continue to grow in the future. The largest sector for growth is the petchem sector, where there are essentially very few commercially viable substitutes to make the array of plastics and plastic products that the world consumes in many forms today. The transportation fleet, electric vehicles get a lot of attention, and we do think that eventually that sector of oil demand will peak and begin to decline as EVs penetrate the fleet. However, that will take time. So we don't see that happening in the near term, but post-2030, post-2035 in particular, that could very well be the case for the transportation fleet. And that would start to weigh on oil demand. So with regard to the energy transition, there are an array of pathways to get to lower carbon outcomes in the future. And the world will likely at some point find itself upon one of those pathways. However, it's important to keep in mind, and is shown on the chart here, even in some of the low carbon outcomes, the trajectories that are towards the bottom end of the range shown on the chart, there is still oil demand as far out as 2050 and beyond. So again, the main theme that I want to convey, and in terms of how we think about our business, is that the world will continue to need oil for a very long time in order to provide affordable and reliable energy. So turning to global oil supplies, and coming back a little bit to where we are today, the OPEC and Russia and allied states coalition are doing a lot to help today's market rebalance, as I mentioned a few moments ago, and that is helping to reduce global inventory. So that's the inventory balance is really one of the benchmarks that we look to determine what direction prices are likely to go and whether or not the market is in a surplus or shorted situation. So the cuts that this coalition agreed to in November of 2018, they've been adjusted over the past 1.5 years in accordance with market conditions. And the group today is producing below its capacity, as shown in the charts for Q1 of 2021. So as the global economy and the global oil market continue to recover in 2021 and 2022, we do expect the Russia, OPEC, and broader coalition to return production to the market and eventually regain at least a 50% share of global supply. Focusing on the US for a moment, US production in Q1 2021 was back up to its Q3 2018 level. That's a relevant benchmark because that's putting it in line with where the Russia and OPEC coalition was at just prior to the major deal that they undertook in November of 18. But it's also important to keep in mind with respect to US production that between Q3 of 2018 and today, US production had risen to peak at about 18 million barrels per day in early 2020, just prior to the pandemic. So the US is below that peak, but expected to grow in the future, and we'll get to that a bit more in just a moment. But when we think about the overall supply picture for the global oil markets, both production from the US and OPEC, Russia, and the broader coalition, growth from all these areas will be needed in the future in order to satisfy the growth in oil demand. So focusing a moment on the global cost of supply, we've seen significant reductions in break-even costs over the past few years. And this helps to solidify the place of US production, particularly US tight oil, alongside other sources of low-cost supply, in particular Russia and Saudi Arabia. So one reason that US producers have been able to grow production in the past, and the reason that we believe US production will grow again in the future, is the deployment of technology and innovation all across the tight oil plays. And these innovations can then be transmitted or shared within companies across business units. So improvements that originate in the US lower 48 frequently get transmitted across business units within companies to other regions and can help to bring down a given company's overall cost of supply. So on this slide, we see the improvement over time in the initial production rate across the major tight oil plays and the corresponding decline in per barrel prices. Here, the focus is on the Permian. And these are the prices, the break-even prices that are needed to make new wells economical. And you can see the decline in the expected WTI price to break even on Permian production. So as US producers continue to innovate today to further reduce costs and maintain competitiveness with other sources of global supply, that maintains US position within the global supply mix. So looking at the outlooks for US production, here I'm showing you a range of industry experts' forecasts. And as you can see, these generally trend up through 2030. Some go quite high and then some tend to plateau. These projections were actually higher prior to the pandemic, and that's tied to the fact that the US resource base is a very cost competitive, low cost resource base on a global basis. But coming through the pandemic and coming to where we are today, above ground factors have caused many of these experts to make some downward adjustments to their outlooks. But as you can see, there's still an outlook for growth ahead. Now, to comment briefly on why the downward revisions were made, that's tied to above ground issues, primarily consolidation within the industry, capital discipline, and the focus on returning free cash flow to investors. And then, of course, ESG factors are very prominent, and that can affect companies' cost of capital and other costs. What experts do generally agree upon is that among the plays that comprise US production, the Permian will lead growth in the future and continue to be a very large component of overall US production. And across plays, it's very likely that the best acreage will eventually get drilled. We've seen some evidence of that in plays, both oil and gas plays today. Productivity gains are expected to continue, but will get harder to achieve. So it's the issue of diminishing marginal improvements. Improvements are still positive, but they're getting smaller and harder to find. And eventually, as these things play out, the underlying base decline rates of the wells will start to overtake the growth, and we should expect to see production flatten and eventually decline. But we do expect that to be much further out into the future. So going beyond oil, let's restart this slide. So going beyond oil for just a moment, let's look at the total energy mix. Oil is still needed to help meet global energy, and even in the IEA's Sustainable Development Scenario going out to 2050. So that's a long life ahead for oil. And the sector is going to need to invest, by the IEA's estimates, the sector will need to invest anywhere from 10 to $20 trillion over the next 20 years to meet a range of energy demands. Here we're looking at the Sustainable Development case and the stated policies cases and the IEA's estimates for those. So it's a very important aspect to think about with respect to the oil sector, is the fact that the natural declines of wells means that we're never standing still. So one always has to keep reinvesting and drilling new wells in order to backfill the natural declines in the others, and that takes capital. So in summary, the global oil market is on a path to recovering today, with inventories normalizing, and we do have a positive outlook for demand in the future, both next year and beyond. And that's tied to the fact that oil demand is in many sectors is hard to substitute for, and turnover in the transportation sector will take time. Turning to the supply side, global supplies will be needed from many regions: Russia, OPEC, a lot of non-OPEC regions, as well as the United States. And the United States is expected to continue to play a very prominent role in global oil supplies and be a major producer for many years into the future. And then lastly, the sector does need to continue to invest in order to, and deploy capital in order to keep production at a high enough level to meet global demand. So thank you very much. I hope you enjoyed the session.
Thanks very much, Helen. That was great. You know, I noticed in your slide on IEA's Sustainable Development Scenario that oil demand was still in 2040 close to 60 million barrels a day. They had a significantly lower number for oil demand in their net zero by 2050 scenario. And I think we'll talk about some of the risks and challenges associated with that. Bassam Fatou will discuss aspects of risk reduction, economic diversification, and adaptability resilience in the oil sector. So over to you, Bassam.
Good morning, good afternoon, and good evening. I hope you are all well and you are keeping safe. My name is Bassam Fatou, and I am the director of the Oxford Institute for Energy Studies and professor at the School of Oriental and African Studies, University of London. I would like to thank the IAEE for their kind invitation and for this opportunity. In my presentation today, I will focus on the energy transition, the challenges it poses to the oil sector and to oil exporters, and the adaptation strategies that oil exporters could pursue to confront the risks associated with the potential disruption of the energy sector. Oil rains have brought massive benefits to oil exporters, as reflected in most economic development and human capital indicators, though this have occurred at varying degrees. But we also need to recognize that heavy reliance on oil rents has also created its own economic and institutional challenges. Instability and volatility of oil revenues contributed to macroeconomic instability and volatile growth. Oil rents contributed to weak institutional environment and many economic distortions: a weak private sector, rigid labor markets, inefficiencies, subsidies which distort production and consumption decision. And this has been reflected in weak economic growth and declining GDP per capita over time. As the graph on the right shows, over the past 20 years, a larger dependence on oil export was on average associated with lower growth for oil exporting countries. And I would argue that these challenges are becoming more pronounced at times when prospects for oil demands are more uncertain due to the energy transition and decarbonization policies. Many are predicting an imminent peak in global oil demand, driven by technological improvements, acceleration in efficiency, climate change mitigation, competitiveness of renewables, and changing social preferences. But it's quite important to remember that oil demand projections are highly sensitive to underlying assumptions of the model. They rely on assumptions such as economic growth, population growth, transformations in the transport sector. And by changing these assumptions, one can push the peak forward or backward by decades. Also, most of these projections assume that there's a single peak after which oil demand declines sharply. And it's quite important to emphasize that there's no consensus on many of the underlying assumptions. Some of the widely used assumptions, for instance, are based on historical trends, which show that fast transition in energy system has rarely happened. Others tend to assume that the speed of the energy transition is uniform across the globe and is linear. These underlying assumptions should be critically assessed. Many models tend to project the evolution of oil demand based on historical trends and reach the conclusion that oil demand will continue to grow all the way to 2050 and will remain an important part of the energy mix. Massive infrastructure built around oil, lock-in and path dependency, and huge sunk costs create inertia in the system. These studies can point to the evolution of other fuels, such as coal, which still constitutes an important part of primary energy, despite efforts to replace it in the energy mix. On the other hand, others argue that this energy transition has special features which will make it proceed at a much faster rate. Few features stand out. The first is that the world is responding to a global problem of climate change. The energy transition is driven in big part by government policy. The costs of clean technologies keep going down. The transition is not being influenced only by developments in the energy sector, but draws in technological advances in other sectors, such as digitalization. Finally, there are fundamental shifts in consumer, governments, and financial behavior, who are all pushing in one direction to reduce emissions. These alternative views of the speed of the energy transition and the fact it's driven by government support imply few things. First of all, that the speed of the energy transition is highly uncertain. The second one, that it will be highly uneven across the globe. And the third one is that the energy transition will not be linear. There is no single transition path. Governments will pursue different paths depending on many factors, including their initial conditions and portfolio of assets. What it also points out that coordination and cooperation is key to advance the energy transition, and this requires new governance structures. Regardless of the speed of the energy transition, it's quite important to recognize that the impacts are already being felt. There's a difference between the time scale within which the transition results in a fundamental change in the energy mix and the time scale within which the manifestation of its impact on energy markets are being felt. Perceptions and players' behavior are shifting much faster, and they are already shaping the energy industry and key decisions. For instance, this is affecting investors' risk preferences and financing costs and availability of finance for some of the projects. And this pressure to decarbonize will only increase, and we're seeing this through divestments, shareholder pressure, government policy, and consumers' shift in attitudes. And in a way, the international oil companies are already adapting their strategies to this. So they are incorporating climate-related targets into their strategies. They're reducing the share of oil assets in their portfolios. They're increasing the share of gas and renewables and clean technologies. and they have most announced very ambitious targets to reach zero emissions. Now, the biggest shift in perception is that from oil scarcity to oil abundance. A few years back, we were talking about peak oil supply and scarcity rents. Now we talk about peak oil demand and oil abundance. A few years back, it was all about how to preserve and manage resources for future generations. Now there's plenty of talk about significant amounts of oil may never be extracted. In the past, producers recognized that oil prices are volatile, but generally there was a belief that oil prices will continue on a rising trend and the oil industry will continue to generate higher margins. Now there's plenty of talk about slowing oil demand growth, competitive oil markets, falling margins, and very uncertain future demand for oil export. Now, the key question to my mind is, what adaptation strategies should oil exporters adopt, given the domestic economic and political constraints, an energy transition which is changing the prospects of oil demand, but whose speed is uncertain and whose impact is not uniform, and at times when perceptions and policies are changing fast. Oil exporters face a graver challenge than international companies, and this has to do with the fact that their proved reserve to production ratios are of multiple decades. So they face the challenge of monetizing a very large reserve base. And quite important is that the risk of losses in export revenues, which could disrupt their socioeconomic well-being, given the high reliance of their economies on oil revenues. And in this uncertain environment, the long-term fitness and adaptability can be improved through two pure risk reduction strategies or their combination. The first one is the diversifying bet hedging, and the second one is the conservative bet hedging. And I'm going to spend a couple of slides explaining each of these. The essence of diversified bet hedging is reflected in the old saying, don't put all your eggs in one basket. A diversified strategy reduces the variance of return, and the mechanism through which this could be achieved is risk spreading. For instance, you create new sectors other than oil and gas and generate new sources of revenue, for instance, through taxation. Now, that initiatives on economic diversification has featured in the development plans of many oil exporters for decades now. Attempts to expand to new sectors such as banking and financial services, tourism, entertainment, as well as agriculture, but this basically has occurred with a very much mixed success. Those countries face real challenges to realize a meaningful diversification strategy. And this has to do with the fact that any diversification strategy is successful if it offers risk reduction by pooling uncorrelated income streams. Diversification into different areas away from their core competitive advantage runs the risk of failure of establishing viable non-resource export sectors. Also, achieving diversification requires building a human capital and improving the education system, as well as extensive reforms to improve the business environment, enhance transparency and economic governance, reduce the excess monopoly rents in the non-tradable sectors, and quite important as well, removing barriers to private sector participation. And there is uncertainty about whether and how quickly such extensive economic and institutional reforms can be implemented in most oil exporters. This does not mean that ambitious reforms have not been achieved. We have seen, for instance, in the Gulf, the oil exporting countries introducing energy pricing reform, labor market reform, fiscal reforms, and even introducing new sources of taxation, such as indirect taxes and value-added tax. The point that I'm trying to emphasize that the diversification is long and a complex process, and it's not going to proceed uniformly across oil exporters. And this has to do with the multiple features of resource-rich economies, which make diversification a difficult and lengthy process. Largely geared towards non-tradables, so it contributes little to export earnings. A fiscal structure designed to heavily rely on oil revenues with few other additional sources. Rather than private sector and individual being taxed, instead they receive subsidies. We're talking about fiscal rigidities, which limit the scope and flexibility of public expenditures. We're talking about large public sectors, highly segmented labor markets, an education system that fail to produce the skills that are required by the private sector. And that's why real and meaningful diversification can only be achieved by deep and painful structural reforms. And some countries are much better equipped than others. And that is why to expect oil exporters to diversify away from the oil sector, which constitute its core competitive advantage, and for this strategic sector to play a lesser role in the transition process is not realistic nor optimal, as these economies will be limiting the risk reduction strategies. After all, the oil sector remains very profitable and enjoys higher margins than any new industries that the government aims to establish. Governments can leverage on oil revenues to ease on the pain of reforms through developing compensation and offsetting mechanism to offset the impact on firms and households. Oil sector can also contribute to diversification efforts by creating forward and backward linkages. Therefore, in addition to diversification, MENA oil exporters can pursue a conservative bet hedging. And the essence of this strategy is reflected in the old saying, a bird in the hand is worth two in the bush. And at the core of this conservative bet hedging strategy is to improve the competitiveness of the energy sector and increase its resilience against potential risk of disruption. And this involves taking a set of key measures, lowering the cost and improving the efficiency of oil and gas production, reducing the emission in oil and gas production, lower the carbon intensity of this production, improving the efficiency of domestic use of energy and optimizing the energy mix through introducing natural gas and renewables and nuclear, shifting the portfolio towards petrochemicals and non-combustible uses of oil, reducing the emissions in the consumption of final petroleum products through CCUS, hydrogen, ammonia, and invest in clean energy technologies, including renewables, hydrogen, and CCUS. And as I argued before, some countries are better positioned to embark on this route. Now, the return on conservative bet hedging strategy is lower than the current default strategy of just exporting oil and gas, given the cost involved in reducing emissions. And therefore, we should expect lower margins. But it's also important to emphasize that this also lowers the risk profile. Decarbonization technologies are well established, and there's significant room for cost efficiency gains. And R&D in these areas is progressing very fast, and countries can exploit those changes in the cost structures. This strategy is less complex to implement, given the links with existing hydrocarbon business. And countries can still continue to export hydrocarbons and benefit from the generated rents, while improve the return on clean products and take advantage of the potential dislocations that could arise during the energy transition. For instance, there will be periods that we could see supply falling faster than demand due to lack of investment, or as companies start shifting their portfolios away from oil assets, or actually as a result of disruptions that could result due to instability in some of the oil exporters. Now, every strategy has its main drawbacks. And to me, the biggest drawback is the following. Can frameworks be established so costs are shared and certain technologies are not discriminated against? Also, could we end up growth of, in a world where we see growth of decentralized technologies, where it makes it increasingly difficult to extract trend beyond marginal costs? Over the last few decades, many oil exporters have been trying to hedge their bets through diversification efforts. And this reveals that these countries have had hope and perhaps confidence that the outcome of this strategy will likely to be in their favor. But the long-term strategy for oil exporting countries is about risk reduction and not just about revenue generation and diversification. Risk reduction strategies based on their portfolio of assets and competitive advantage should be an integral part of these policies. This might entail accepting lower return on their existing assets, but as I argued previously, this also lowers their risk profile and increases their resilience at times of high uncertainty associated with the energy transition. Thank you very much for your attention.
Thank you, Bassam, for that very interesting presentation. The idea of margins coming down because of the energy transition, but being offset by lower risk is very intriguing. I know Saudi Arabia, for example, on that one chart that you showed, has one of the lowest carbon footprints for its oil. So markets for low carbon oil could be long lasting, and is one way, I think, of getting to that resilience idea that you mentioned. Francesca now will share a perspective on the potential for climate policies to create stranded assets for oil. And this is one of the issues that Bassam brought up in his presentation as well. So Francesca, over to you, please. Thank you.
Hello, everybody. My name is Franziska Holz. I'm from the German Institute for Economic Research, the IAEE Berlin, and from the Norwegian University of Science and Technology, NTNU. And today I would like to talk with you about the long-run perspective for oil markets between climate policy and stranded assets. This is based on joint research with Davoud Ansari and Marisa Montes-Leoca-Leon at the IAEE Berlin. Let me share my screen with you. You're certainly aware that climate change requires us to reduce our emissions. And very importantly, fossil fuel consumption and fossil fuel extraction will have to play a major share in that emission reduction. The IPCC, just as many other institutions, has provided us with a number of scenarios of climate mitigation efforts. And we see that across scenarios and across models, the trend of downward fossil fuel extraction and consumption is the same. It may be stronger or less, but there is a univariate downward trend in fossil fuel extraction. We may wonder what share oil plays in that. And first evidence shows us that oil may be less affected than coal or natural gas, but it definitely cannot escape the downward trend. In their seminal paper 2015, McGlade and Eakins said that about 35% of global oil reserves would have to stay in the ground until 2050 if a 2 degrees Celsius world would have to be achieved. And even more in natural gas, more than 50%, and in coal, with almost 90% of the reserves would have to stay in the ground. So oil would be less affected, essentially because we assume today that the transportation sector and the chemical industry, which are strongly relying on oil today, are harder to decarbonize, so that oil is harder to replace by renewable fuels in these sectors. So oil has to find its role in a changing energy mix. Essentially, we see a decrease of costs of renewables, and the extent to which that decrease happens may change across scenarios and pathways, yet the decrease is there, and it already started very substantially. And it happens and is so strong that it cannot even be compensated by technological progress in oil extraction, which would also lead to a more or less pronounced reduction of oil extraction costs. So across scenarios, the share of oil would decrease in the future. Here you find numbers and results for 4 scenarios that we did at IAEE Berlin, where we defined a very large space of strongly differing scenarios between a business as usual world, where fossil fuels continue to play a strong role and only mild climate policy ambition exists, to a very strong climate ambition world with a strong role of renewables, including the strong decentralization and smart efforts. And in between scenarios with strong climate policy efforts, yet mostly relying on technology solutions such as CCS, and another scenario where the conflicts of today's world are exacerbated and where a strong use of fossil fuels is even further pushed and focused on, which we call a survival of the fittest world. And yet in all of those very strongly diverging scenarios, the share of oil reduces drastically, and the share of renewables in turn increases strongly. So what does this imply? Well, there will be stranded assets in the global oil sector. Stranded assets are defined by Caldecott and his colleagues, who are really seminal in this research stream, as assets that suffer from unanticipated or premature write-offs, downward revaluations, or that are even converted to liabilities. So all assets along the resource extraction value chain can actually be concerned. So it could be reserves, as Mesglade and Eakins focused on, but it could also be production capacities and other infrastructure. As you know, a lot of the infrastructure in fossil fuel industry is actually specific, cannot be used for other purposes. An oil terminal is an oil terminal and can be used for oil or maybe oil products. So if it's not used anymore because demand has gone down, well, it's a stranded asset. So resource owners, but also asset owners in the fossil value chain will be affected by stranded assets. And that poses risks. On the one hand, an economy-wide risk, because the loss of revenues from those sectors, but also the loss of employment in these sectors will be risks to economies that are often very strongly dependent on fossil fuels, on oil-rich countries you can think of, but also risks to effective climate policy, because resource owners that must fear to lose their revenues, well, they will not be inclined to participate in climate change mitigation efforts. So stranded assets are something that needs to be taken into account if we actually want to achieve effective climate change mitigation. Yet stranded assets, as popular as they are now as a concept, they are a relatively vague concept in my understanding. They are derived, just as I did it in the past minutes. We set a certain climate target, 1.5 degrees Celsius or 2 degrees Celsius, and then we compute the necessary emissions abatement. And from that, we compute energy consumption paths that are in line with the remaining carbon budget. And more importantly, even we compute fossil fuel extraction paths that are in line with the carbon budget. And with those fossil fuel extraction paths, we can see what are the remaining requirements in terms of extraction capacities, in terms of fossil reserves, and other infrastructure, like transportation infrastructure. And those assets, those capacities that are not required anymore, is what we can call stranded. But yet we can ask a few questions about this concept. In the first place, we can ask what's actually unanticipated about that and about climate targets. They've been around for several decades now. Maybe the further strengthening and stringency of climate targets is something that was not unanticipated for some decision makers on fossil fuel assets at the time of decision making. Yet, at least today, and for quite some years now, the 2 degrees Celsius target and the 1.5 degrees Celsius target have been around for long enough to be taken into account. But we know that they're not often not yet when fossil production capacities, oil extraction capacities, etc., are decided for. Another sort of challenge of the concept is that we may see that resource owners actually react with anticipated extraction to climate targets in the future. So with something like a green paradox, which actually means that over time, the total resource extraction and hence the emissions are actually the same as if they had been extracted later. And then very importantly for the definition of what are actually stranded assets is the question, what's the baseline? What do we compare the asset use under a certain climate target to? Do we compare it to a business as usual scenario with low climate targets? Do we compare the asset use to today's assets in place? If we talk about today's assets in place, do we mean the production capacities in place, or actually do we mean, let's say, oil basins or oil fields that are in extraction already? And what does that mean for rigs that have to be put into those fields in the future to continue extracting from that same field? Are those future stranded assets, or are those actually part of today's assets? So it's a relatively vague concept that are actually having challenges in terms of quantifying the stranded assets. Yet, I've also propose another way of quantifying stranded assets, in particular of giving a quantification of the risk of asset stranding. At the IAEE Berlin, we developed a regional and fuel-specific index for the stranded assets risk, where we combine two aspects that are important when we talk about future use of fossil fuel assets. That is, on the one hand, the importance of a particular fossil fuel in the overall energy production mix, so the fuel production dependency, and on the other hand, the variation across scenarios between strong climate policy scenario and a low ambition climate policy scenario, if you want. And if that differs a lot, well, we are not sure that assets that are in place or that are invested into will actually be used in the future, because the ambitious climate policy scenario may realize. And for 3 case study regions, the Middle East, China, and South America, we find that the stranded assets risk is actually very high in the oil sector. It's high for different reasons, depending on the region. In the Middle East, there is particularly a large dependency on oil in the overall energy production mix that pushes the high value for that index, but it's also the large dependency on exports that pushes this high value, because import countries, say in Europe, North America, etc., may actually go for very strict climate policy depending on the scenario, so may have a large variation between scenarios in their oil consumption. In South America, which also exhibits a high risk for stranding its oil assets, it's particularly that strong variation between scenarios that drives the high value, and the high costs of extracting oil in this region drive that there's a high difference, a large difference between production values across scenarios. Interestingly, only for the Chinese coal sector is the stranding risk even higher, which is sort of an obvious one, of course, because the coal phase out is a low-hanging fruit in high climate policy ambition scenarios. But oil comes very short after. So how do we deal with this risk of stranding assets? Well, the main challenge really is the loss of revenues from oil assets, from oil production, from oil extraction, from oil sales. And it's a challenge for the established channels of rents, of oil rents. In particular, we talk about countries that are very often have bad institutional regime or poor institutional regimes. So oil rents serve to maintain those institutional regimes which rely on corruption, on nepotism, and other, well, really poor institutional regimes characteristics. One sort of solution to induce oil-rich countries to participate in international climate policy efforts is to offer compensation payments by the international community. It's a challenge in itself that I don't want to discuss here, and it wasn't successful so far. But we can wonder, is it actually sufficient to offer compensation payments? And even more importantly, we can wonder, is it desirable to offer compensation payments given that they would actually delay institutional change in oil-rich countries? Rather, other challenges must be addressed when we think about the future development of oil-rich countries in a climate policy environment. That is institutional change involving, in particular, a transparency of oil rent flows and also economic diversification. So a reduction of the importance and of the dependency on oil revenues. Yet transparency of oil rent flows and diversification are really hard to achieve. Let me give you two examples. The first one is sovereign wealth funds. This is an instrument that was established in many oil-rich countries in the past decade or so, where oil funds or pension funds, as they're also called, were created. Yet we know that only Norway really has achieved a transparent system with strict spending rules and an effective system to keep current oil revenues to a large extent for future generations. Other countries have depleted their funds when oil prices went down, have taken a lot of current budget expenditures, state budget expenditures from their oil funds, etc. Or we even don't know which share of current oil revenues goes into the fund and which goes into other more private pockets. So the overall institutional regime also seems to be very important to the successful establishment of sovereign wealth funds. And it's a hard one for a lot of oil-rich countries with poor institutions. And let me give you another example. That is, a lot of oil-rich countries actually subsidize the consumption of oil, in particular of oil products such as gasoline or diesel, for their own population. It's a very popular measure and policy in Latin America. And together with my colleague, Marisa Montes de Oca Leon, we've looked at what did phasing out fossil subsidies actually has as an effect in Latin America. You would think from sort of the outside perspective that reducing or phasing out fossil subsidies is a low-hanging fruit in several respects. It could be an effective means for climate change mitigation because it could reduce emissions by reducing the consumption of gasoline and diesel because of higher prices without subsidies. But it could also be an effective policy to increase the fiscal space and hence to reduce the need for oil revenues for the state budget. Yet what we find for Latin America is that such a policy of phasing out fossil subsidies is a risk for the popularity of the decision makers in this region of the presidents, because they have strong presidential regimes. If we look here for Mexico and Bolivia at the popularity of presidents around the introduction of a fossil subsidy phase out, we find that in a virtual, in a synthetic situation, without the fossil subsidy phase out, which is the dashed line, the presidential popularity would have been higher than it was in reality with the fossil subsidy phase out, both in Mexico and in Bolivia, indicating it's probably a policy that is very hard to carry out by political decision makers. And this is one obvious reason why we still have a lot of fossil subsidies around the world. So let me end with a question that I would like to discuss with our panel, namely, can international climate policy actually ever successfully involve oil-rich countries, given all the obstacles that I just explained. I look forward to the discussions and thank you very much for your attention.
Thank you, Francesca. That was really interesting. Along the lines of the question that you asked at the climate summit that US President Joe Biden held a month ago, they made an announcement that Canada, Norway, Qatar, Saudi Arabia, and the United States were forming a new international forum to talk about global net zero emissions strategies, calling it the Net Zero Producers Forum. So it kind of addresses the question that you asked. They wanted to focus on 4 key areas: development of methane abatement strategies, advancing the idea of the circular carbon economy, which says in addition to reduce, reuse, and recycle, that we would add remove carbon dioxide from the atmosphere as a 4th item. Developing strategies for hydrogen deployment and diversifying economies. So it kind of comes back to the thought that you had. I also really enjoyed your comments on the main challenge of loss of oil revenues with stranded assets. I know that Mark Carney, the former governor of both Bank of Canada and Bank of England, had talked about stranded assets for a long time. One of the things that I remember from my days as a financial analyst is that investors generally tend to have very high discount rates. And so assets that are stranded a long time from now might not be worth very much to investors today. But if it was nearer term, it would be really important. And that would be an interesting area, I think, for research for any of the IAEE members who would like to look into that. I would love now to get everybody get your videos running and unmute yourself. We've had questions come in already from audience members, and we'll get to those as we can. We have a good half hour. Everybody stuck to their time, so thank you very much indeed for that. And I'm looking forward to going through the Q&A session. I'd like to just offer a question of my own, Helen, to you, circling back. The question, and it kind of ties into some of what both Bassam and Francesca talked about. During your talk, Helen, you mentioned mid and long-term outlooks for US oil. And you indicated that capital discipline, is a new feature of that. Could you elaborate a little bit on capital discipline and ESG? ESG, I think everybody has heard that phrase, but it's environmental, social, and governance factors in operations of oil companies. And I think it kind of comes back to some of the things that Francesca was talking about too. Could you tell us how you think US companies are reacting in this space?
Sure, thanks, Adam. So the notion of capital discipline, just to be clear on what we mean by that, that's what has become general vernacular, I would say, for companies focusing on taking free cash flow and as opposed to reinvesting that in growing production, prioritizing that free cash flow to returns to investors, whether they be equity, debt, other types of investors. So it's providing returns to investors. And we do see companies sticking to capital discipline today. If we think of over the last 12 months or perhaps longer, there's a lot more focus by publicly traded companies in particular on returning funds to investors. We're seeing that today, even as the markets, as oil prices have moved up here in 2021. The rig count has moved up in the United States, but the rig count has not moved up as quickly as I think some analysts, some market analysts were expecting. And you add to that some of the commentary that many companies have made in their quarterly earnings calls thus far in the year. that capital discipline remains the order of the day. So we think that that is going to persist for some time into the future. That's one component that shapes the outlook for U.S. production. And so, Adam, you also mentioned the ESG, or environmental, social, and governance factor as well. And for us, that plays into our thinking really in two ways, both of which are cost. So it's cost of capital as well as operational cost, insofar as you may incur some incremental costs to reduce emissions at your well site. But those are both factors that the industry takes very seriously, and will also continue to shape the outlook for production, not just in the United States, but globally. These are in fact global issues that companies are embracing and going along with.
Francesca, I'd like to circle back to you for just a second. I mentioned that this Net Zero Producers Forum had methane abatement as one of its key areas of interest. And I believe that the EU, the European Union, is currently preparing stringent methane content regulation for oil and gas imports. Could you give us a little bit of color on that? And do you think it's actually going to limit imports of hydrocarbon fuels based on the methane footprint?
Thank you, Adam. This is a very good question. The regulation is still in the making, so we don't know exactly what it will look like, but it's likely or possibly looking like a price that will be charged on oil and gas exporters, and the price would be higher if the methane footprint of the imported oil or gas is higher than of an alternative oil or gas exporter. That raises two challenges. The first, of course, is the price, but the other really big one is to know how big is the methane footprint of a particular oil or gas source, which this regulation sort of has spurred a lot of activity of going into measuring the methane leakage and the methane emissions from the value chain of inputs into Europe. So in the future, let's say in the medium term or long-term future, when this regulation really is in place and when we have data, I think we can definitely expect a redirection of trade flows. I'm not sure if based on this regulation, we can expect the reduction of imports, but certainly a redirection in the sense that countries with a higher methane footprint of their oil or gas would avoid exporting large amounts to Europe, rather export to regions in the world without such a regulation. And while there would be a preference in Europe to import from oil or gas exporters with a lower methane footprint, or with good measurement data. I mean, for the time being, it's only Norway that has such good measurement data. But as I said, there is now increasing activity to bring satellites, etc., to measure this. So it's a very dynamic area.
Right. You mentioned right at the end satellite monitoring of methane. I think that's becoming more common and less expensive to do, and that could play a big role. I know there are wide variances between countries and companies in methane, and I can understand how you could say that it might shift the trade patterns around. But Sam, let me come to you. I mean, this is an interesting question. Your expertise is in the Middle East and North African area. Do you see the economic and geopolitical consequences from things like this, possible methane control or issues associated with carbon management? How is this going to be handled in the Gulf region?
Adam, many are of the view that the Middle East oil exporters will emerge as the definite losers from the energy transition and climate change policies. And of course, this is based on the premise that oil demand will decline and it will erode the importance of oil as a strategic commodity, and it will erode the geopolitical position of oil exporters. Also, there is a belief that in a falling market, at least according to this view, oil exporters will engage in fierce competition for market share, and that is likely to result in lower margins and revenues. And given the undiversified economic structure of these countries and the rigidity of their spending, this might result in economic disruptions and instability, which could destroy even the social fabric of these countries. But I would argue that this type of analysis is simplistic for a number of reasons. First of all, when we talk about MENA oil exporters, it's important to recognize that this is not a homogeneous group, and their resilience and core sources of competitive advantage tend to vary tremendously. Take, for instance, the major oil and gas producers of the GCC. These countries have some core competitive advantage, which allow them to adapt better to the challenges associated with the transformation of the energy transition. For instance, you can think that they have a very well-developed and highly integrated energy sector. They have a massive reserve base and some of the lowest cost of production in the world, allowing them to compete in any market situation. So that's why I was a little bit surprised of what I heard that, that the risk of stranded asset in oil in the Middle East is quite high. Also quite important to remember that those producers also have low carbon intensity, low gas flaring, and low methane emissions, which actually allows them to compete in dimensions other than cost. And this is likely to become more relevant as carbon taxes become more important. But Adam, even if you look in terms of clean technologies, the energy transition will offer some of these countries opportunities. For instance, they have abundant renewable potential. They have great potential, hydrogen potential in all its colors. And these potentials actually can be developed within the frameworks which are coming out from the region, and something that you are very much familiar with, that, for instance, the circular carbon economy approach. And I think the last point, and the most important point in my view, is that the major oil exporters are not standing still, and they are evolving and responding to the challenges that the energy transition may bring, with many initiatives such as I mentioned the circular carbon economy. So I think this is really not realized if you look at the reforms, if you look at the things that are happening there. So I think to me the issue is it's not whether they are going to lose their geopolitical position, is basically more about the ability to adapt and increase resilience. And that's why I emphasize in my talk that it's about resilience, and the energy sector needs to play a key role. But of course, this requires vision, serious reforms, innovation, and actual investment in the resilience of the energy in the energy sector. One final point, and I know I've taken a long time to answer your question. And we need to recognize as well that the producers' approach and the exporters' approach to the climate change challenge has fundamentally changed. And now they are they're recognizing the climate change threat, and they want to be part of the solution. And whatever frameworks globally, they actually should count on this, and should actually try to incorporate inclusive ways of including those producers as being part of basically part of the solution to this problem.
Some of your comments actually have triggered a couple of questions that go back to the idea of stranded assets. This is a comment from one of our viewers regarding stranded assets. Is it possible that oil or natural gas pipelines could be repurposed for oil pipelines for biofuels, natural gas pipelines for moving carbon dioxide? And what about carbon capture and storage? Is CCS going to play an increasing role? And it'd be. Let me just make a quick comment on that. An alternative scenario to the net zero by 2050 scenario published by the IAEA recently could include more use of carbon capture and utilization technologies. It might include more hydrogen. It might even include more nuclear if we see those costs come down. Everybody, I think, agrees, and certainly even in this region, agrees that efficiency and renewables are likely to be a huge part of the future energy mix. And in fact, one of the world's largest green hydrogen projects is underway here in Saudi Arabia. Blue hydrogen ammonia is being explored very intensively in the region. And, you know, I think about to the extent that oil and gas fields aren't used for as much oil or gas production, they might be used for storing carbon dioxide, you know, or both. Enhanced oil recovery can store almost as much. Some of the evidence from companies and governments who have looked into this is that the carbon dioxide used in enhanced oil recovery actually stays in the reservoir. And so what we I think are going to need is negative carbon dioxide technologies. We need to be able to get it out of the air, direct air capture, and put it somewhere. Nature-based solutions probably need more attention. Things like ocean solutions, seagrass, mangrove, coastal restorations, forestry on land, and so on. These nature-based solutions, I think, have great potential. I think the ocean aspects of nature-based solutions haven't really been explored, and they can be done at scale. I mean, one of the interesting things about CCUS is it's scalable, but many of the nature-based solutions are too. So let me just take a breath and come back. Francesca, maybe this has triggered some thoughts in your mind. You know, I give you an opportunity, please, to come back and tell us what you think.
Yeah, thank you, Adam. Let me maybe come back to the initial question from the audience about repurposing of infrastructure, which is also sort of then bringing us in the direction of substituting current export goods by cleaner energy goods. And I think both are viable strategies. I have a little more doubt about the scaling potential of both possibilities, but definitely, I mean, in Europe, we talk a lot about hydrogen now and about repurposing at least those of our pipelines that are technically apt for that, of our natural gas pipelines to hydrogen pipelines, and that's certainly a possibility. We also investigate if LNG, so liquefied natural gas terminals, can be repurposed for hydrogen. And at the same time, we look at exporters of hydrocarbons like Saudi Arabia to become exporters of hydrogen. And for us in Europe, Russia is another big player where it's really important to also keep, let's say, sort of stable energy relations, because that's sort of the core of our geopolitical relationship with this country. And hydrogen could definitely be an option. We don't really have other options at hand right now. And I believe it's really worth investigating into those clean energy options, including repurposing of assets, which will reduce the risk of costly stranding.
Thank you.
Adam,
Helen,
I'd like to jump in here a moment and also comment on that. I mean, with regard to that the original question around repurposing pipelines, as Francisca was saying, I think there are huge opportunities for that to occur. Again, as she noted, there are some technical complications that may occur if it's hydrogen, biofuels, et cetera. But those are things that can be overcome. Those are problems we know how to solve. It's a matter of commercial viability. But going to the bigger sort of the bigger theme around the overall transition, I think a comment you made is key, and all of this hinges on technological developments and advances, whether it be carbon capture and reuse or direct air capture. That it's those technological innovations that are critical, along with government policies that prioritize these actions. Those are the things that will really start to move the needle in terms of actually achieving, making a net zero outcome realistic. The IEA report you mentioned, it was a fantastic piece of work. And I look at it in the context of it's a great piece of work, and it's consistent with a whole series of prior works that have come out of research organizations, some of which are university-based, that reach the same conclusion, which is that it requires a global effort that requires government coordination and huge technological breakthroughs to actually achieve. So it's very informative. And again, it plays into a theme that has already existed, and many companies, including my own, are paying a lot of attention to that and planning our business strategy accordingly so that we can be resilient to that.
Helen, just a quick question for you before we go to Bassam, who wanted to make a comment. One of the questions we had from the viewers was, what are the companies doing to prepare for the risk of significantly lower oil demand? And I know you've used the term occasionally, the new normal for oil demand post-COVID. Are we seeing something in the data, either United States or globally, about demand that leads to any kind of insight into this question of should we be preparing for lower demand?
Companies absolutely should prepare for lower demand. I would call that good risk management. I think you would understand that as well. A company always wants to plan around a range of risks and outcomes to your business and know that you can be resilient to that. And my company does that, and I'm confident many other companies do that same portfolio stress testing. When we look specifically at global oil demand, the evidence today is actually pointing us towards regaining the prior norm and growing after that. Even IEA's medium-term outlook, which was released in March, points to oil demand exceeding 104 million barrels a day by 2025 or 2026. So the question becomes one of timing. We know that internal combustion engine fuel efficiency is continuing to improve, so that chips away at incremental demand growth. And electrification in transportation is undoubtedly occurring. Everybody sees it. It's a matter of pace. So for us, the pace of change becomes the root of the question. And when does demand, at a global level, when does demand actually peak? And then what happens thereafter? We see it peaking more into the 2030s and we think a plateau thereafter is more likely for some years before you start to see a steeper decline. But there are a range of views on that.
So maybe good risk management applies preparing for more than one scenario. Bassam.
And also Adam, for more than one peak as well, because most of those scenarios tend to assume that there is one peak and after which oil demand will decline, and quite strongly after reaching this peak. And that may not be this may not be the case. But Adam, back to your point. First of all, as I mentioned before, we need to recognize that we cannot put oil exporters all in the same on the same basket. And the second point that you mentioned, Adam, is that you're aware that many of the oil exporting countries actually are investing in clean technologies. They are, leading on the renewables, at least in terms of cost. They have introduced pricing energy reforms. So they have removed many of the subsidies, at least in some of the petroleum products. And they have been changing their energy mix in order to optimize their energy mix. Now, all of these investment in clean technology is all good. And, oil exporting countries are likely to continue to do so. But this does not mean that, the hydrocarbon sector, should not also basically also receive the attention and the investment that is needed to increase its resilience. And I think the CCUS, as you mentioned, is one of the key technologies that actually can increase the resilience of the oil and gas sectors in MENA oil exporters. And actually, it's one of the technologies that would allow them to utilize their reserves and keep the demand for their products and keep the oil and gas in the energy mix for a longer period. And the challenge is how to create business models. And we're very much encouraged that the business models are becoming more dynamic, and they're trying to look at extracting, storing, transporting. But one thing also one needs to emphasize is that the idea that you need to push all of the costs to the producers alone, and they are the ones that need to do that without looking at the burden sharing, that actually is going to make it difficult, and actually is going to delay the energy transition, and is not going to be inclusive. So the business model and the policy frameworks also should look at ways of how to share this cost more equitably, rather than trying basically to shift everything to producing countries. This does not mean that the producing countries don't need to take the initiative, and actually this is an area where the Gulf exporters and others, they really need to show leadership in doing. But as I said, this requires policy framework and business models, and hopefully this will emerge.
Thank you, Bassam. There's a kind of a tough question, maybe directed at me, Bassam, I'm not really sure, that says there's a lack of independent research, maybe you and I coming from think tanks, lack of independent research discussing the merits, also the limitations of the circular carbon economy framework. Right now, most of the information is coming from oil-rich countries, according to the question. How do we get truly independent research on that? Bassam, maybe you could think about that a little bit, but let me just quickly point out that the G20 summit leaders endorsed the circular carbon economy platform at their meeting in last November. And what they said was that we needed to, my interpretation, I mean, in easy terms is, we need to use every option that we have available to deal with this global crisis, and that no single solution is going to work and is going to deliver the climate goals that we're looking for. That options in the reduce area, like efficiency, renewables, nuclear, are very, very important. Reuse and recycle, turning carbon into useful products, using carbon, for example, to cure concrete, it is definitely worth pursuing. And that the remove options, as I mentioned before, direct air capture, enhanced oil recovery, just geologic storage, nature-based storage, that we need really to apply all of the options. So I would, and many of the G20 countries are not a big oil. Japan is not an oil producing state, yet Japan sees the value in moving all of the levers that we can bring to the table, financial, regulatory, and others, commercial, driven opportunities to get as many possible solutions on the table. So what I would say is that it's not an idea that is solely being driven by oil producing countries. Certainly oil producing countries have a vested interest in looking at it, but I would argue that this is something that everybody should be thinking about, because Bassam, I'm back to your point, don't put all your eggs in one basket. Let's try to, don't build a house with just one tool. Let's try let's try to make sure that we are pursuing as many options as we can. Bassam, maybe you would like to try this. I think it's important because there's a lot of skepticism, and some of that is reflected in the questions that I've seen.
Absolutely, and I think it's an important question, but I think it's also quite important to put it in some context, because if you look at the diversification efforts of many of the oil and gas exporters, the record has been very poor. And to ask them to diversify and structurally change their economies in a short period of time actually is not going to be feasible in most cases. So anyway, those countries have to draw back on their core competitive advantage, which remains the oil and gas sector. This is a sector which still generates high margins. This is a sector which, if there is a lack of investment, is going to provide some opportunities for some oil and gas exporters actually to capture higher rents if investment falls very quickly and if demand does not fall. So there are opportunities, and that is why if you cannot ask countries to move away from their core competitive advantage. On the contrary, they should try to build in those core competitive advantage and try to increase the resilience of their energy sector. And I think that approach of trying to decarbonize oil and gas production, try to decarbonize the final petroleum products, actually builds on certain principles as well. The principle of recognizing national circumstances, the principle that there is no single transition path and no country should impose on other countries one and only one transition path, regardless of their core competitive advantage. And the principle that the costs of the energy transition are not going to be even and they're going to be unequal. And the cost of some oil exporting countries to adjust their economies is going to be much higher. And that is why, there must be a more distribution of the cost, either across the supply chain or, across countries.
Thank you, Bassam, very much. Well, we only have a couple of minutes left now. So Helen, 30 seconds. What's the one thing in oil's role in the energy transition that you think is worth policymakers focusing on?
I think what policymakers should focus on today is that oil is a very important part of the energy mix today. And when you look at the technological capabilities that exist globally today to transition away from oil, that's going to take time. So in the meantime, it's important to continue to be supportive of oil companies and investment, because that energy is needed on a worldwide basis.
Thank you, Helen. Francesca, stranded assets, I think, might be your answer, but maybe not. What's the one thing that you would like to see policymakers focusing on?
Well, maybe I can come back to that carbon circularity question, where I'm as skeptical probably as the person from the audience. And I think at least policymakers in importing countries should make their net zero targets more credible by saying relatively clearly what that means for fossil imports. Does it mean an end to fossil imports, or does it mean at least a decreasing path? There's no transparency on that so far, which spurs all this discussion about oil, gas, maybe even coal still playing a big role in the next decades. So we need to make more transparent what we actually mean by our targets.
Very interesting, Francesca. I noticed you also talked about the policy, possible compensation payments. And, I kind of went, oh my gosh, we pay farmers sometimes to not grow crops. Are we going to pay oil producers to not produce oil?
Possibly.
That's actually a really, really interesting question. Bassam, 30 seconds. What should we do?
From a producer's perspective, I think CCUS and bringing policies and business models that support CCUS at a large scale, I think this is really key, strategic for the oil exporters, because it will allow them to to utilize their reserves, and for oil and gas to continue to be part of the energy mix for a long time.
Bassam, in my 15 seconds, and then we'll close, I would like to add hydrogen to that list. I think that many consuming countries are really interested in green hydrogen. I think that there are opportunities with storage to do blue hydrogen and ammonia, all of the colors of hydrogen. I think putting some really significant government assisted research, development, and deployment into how we might transition towards hydrogen is worthwhile. We tried it some time ago and didn't get very far, but I don't think that means we shouldn't try again. So let me thank everybody, Francesca Holtz, Helen Curry, and Bassam Fatou. Thank you again very much for the Association for Energy Economics France, as well as the International Association for Energy Economics for the great conference that they've been putting on, and the opportunity for all of us to share our thoughts and hopes for a better future.